Hey everyone, Ben Nelson here. Hope you're having a fantastic day. It is time for another market update here for the Portland metro area, and I'm going to touch on some national stuff here and then try to break it down a little bit more locally here as well. There's some interesting things to look at when you look at forbearance and some other things that are, I think, very important to look at. So let's jump into it. I am going to just go over to the Portland, the market action report here real quick, and we'll look at the initial numbers there and see what's been going on over the last month here. So if you look here, here's the market action report. Inventory has ticked up to a whole 0.8 months. So we're almost at 1 month of inventory. But it's actually interesting because it's ticked up just a little bit, and we actually had higher closed sales. So, again, the inventory level is a function of closed sales for the prior month versus what's currently on the market for number of listings. So we are seeing some new listings that come on the market. We are seeing an uptick in the number of residential listings, which is good. We need to see that. I think we're seeing some more new construction, coming up here that maybe got put on hold during COVID. So we're starting to see some more inventory come up. I didn't really dig deep into where that's all coming from, but I would absolutely venture to guess some of it's the new construction coming online, and hopefully some other people that are, off the fence and deciding now is a good time to move, even though it's difficult to transition. You do have to take a little bit more, flexible approach to it. Be willing to maybe be between places for a little bit to make that happen, just because it is really hard to sell and purchase at the same time and do it straight across. It can happen, but it's not the easiest to do. So as I said, new listings increased about 4,300 from the 3,600 in June of 2020. They increased about 8% compared to May of this year. Pending sales went down. I'm going to, again, attribute this to the lack of inventory more than anything else, because interest rates are still extremely good. Demand is definitely there. We are still growing. So that, I think, is just the shortage of inventory that is hindering the sales volume. Closed sales did increase 28% versus June of last year. No surprise there, really. We were kind of still coming out of COVID at that point. Anything closed in June of last year would have had to go pending April or May, and people were still very hesitant at that point. And it did increase about 9% compared to May of this year. And then this is, I can see it in the pricing, and I've been updating some market analysis for some people. I've looked at some homes that were closed recently that some of my buyers went in contract a few months ago. And prices have gone up, obviously, depending on the area and the neighborhood and everything. Both of those situations, I looked at the value in around April, and then I looked at it again this last week, and they had both gone up about 8% or so in the last just few months here, which is a lot in a few months. And then you look at this compared to last year through June, comparing this year through June versus last year through June, over 20% increase in the average sale price, about 18% in the median sale price. So we are seeing a huge upward pressure on pricing. Again, a lot of that has to do with the lack of inventory, interest rates being extremely low. There's a lot of people competing, and when you have low interest rates, you continue to have upward pressure on pricing as long as affordability is still there, which, if you look, I don't know if it's in this one, the affordability index is not in this one, but I know we have been teetering right around that, I think 120% mark, believe it or not, for the Portland metro area. So we are still considered an affordable market based on their metrics. And again, interest rates have a lot to do with that. So I won't spend a whole lot more time here. Again, the only one that's more than a month of inventory is the West Portland area. It has about 370 closed sales last month, about 630 active listings. Everything else is less than a month. And then here's the couple charts. Shows a little uptick in residential listings here in June. Total active listings New listings there again ticked up. Pending sales dropped again. My take is based on the lack of inventory, and then there's your spike in closed sales, and then your continued decline in total market time. What I thought was really interesting is the condo market has seen a huge increase in the median sale price as well. So that's obviously depends on the HOA fees, but this can be looked at as a more affordable option than a single family home, even with the HOA fees, just kind of depending on what type of condo you're buying. So I think you're seeing a lot of upward pressure on condo prices as well because of the potential for them to be affordable. I'm going to jump over here now to look at an update on the forbearance numbers. I'm going to look like nationwide first, and then I'm going to look specifically at Oregon. And I think you'll see a little bit more about how this is probably going to play out once we take a look at this. Obviously, I don't have a crystal ball, but the numbers I think will speak for themselves in what is probably going to happen here. So let's jump over to that really quick. Actually, before I do that, I'm going to jump over to this. Just a really quick article. If you're paying any attention to prices and inflation and those things, this is not a surprise to you, but there's this article right here. There we go. CNN, prices keep soaring, inflation rockets to a 13-year high. Well, if you're putting trillions of dollars of money into the system and just continuing to print and put it out there and give stimulus and all that, what really can you expect? That's kind of, we should see this coming. We should expect this. And unless they start pulling back on that, I think we're going to continue to see more of the same. So again, going back to the philosophy of, we're at the highest prices we've seen in a long time. We're headed into another 2008 market crash. I definitely do not agree with that. And there's a lot of factors behind that. Supply levels, which I'll get into a little bit with the forbearance stuff, just demand. And a lot of those things are just way different than then. We don't have those crazy adjustable rate mortgages. We just lending is a lot different. They're being really proactive about a lot of this stuff to make sure there's not a whole bunch of foreclosures going in the system. But this is a big piece of it too, is inflation. If we have an inflationary economy, which we do anyway, but if we have one that's seeing more inflation than what's normal, that obviously is going to play out in asset prices, and we're going to continue to see rising prices for real estate, for the stock market, for anything where that money is going to be going into the system. That's going to have an upward pressure on the prices. Ultimately, it means that your dollar is worth less, so it's not really like you're gaining any real net worth, meaning you may gain $100,000 in your equity in your house, but if the dollar has declined in value by that same amount, you're really not any better off. You're kind of in the same position overall financially. But anyway, if you look here at this article, over the last 12 months, prices were up 5.4%, which is the biggest jump in annual inflation in nearly 13 years. So a lot of that's at the gas pump. With the price of oil, food prices are up a couple percent. And I've seen this one. We've been trying to look for a used car. Holy cow. Used car prices were up 10% in June, the largest 1 month jump in record. I have seen since we first started looking in January for something, and you could get something for half of the price of new. That was a few years old, and now looking at that same vehicle, you're only saving a few $1,000s by going a couple years old instead of brand new. So it's crazy. So a lot of this is supply chain stuff, a lot of it's supply and demand, but there's definitely just monetary supply that is pushing up prices of these things. So let's look at forbearance now, because this is going to be super important if you're looking at what is that going to do to our market. This is from National Association of Realtors. So I do want to preface this with anytime you're looking at data or conclusions within articles, make sure you're considering the source. And I would agree, and I think if there's numbers to back it, that's obviously going to be super helpful. But if you're just looking at someone's opinion in an article and a headline or something like that, consider the source, because everybody has an agenda, right? Everybody has an agenda. Everybody has their perspective. So if you're looking at something that's saying foreclosures are going to be a huge issue, all this, negative talk about it, where's the source coming from? Who's saying that, and do they have something to gain by putting that slant on the information? Same thing goes with this. Like, I would tend to agree with this, and I think you'll see why when we look at the actual numbers. But this is National Association of Realtors, so what their goal is to prop housing, to put confidence in the marketplace in housing, to generate interest in home buying and all of those things. So they're going to tend to have a more positive slant on things that are going on, because that's their perspective and that's their agenda is to prop up housing and continue that trend in home ownership. So just keep that in mind. And that's not just looking at this, that's just anytime you're looking at news or analyzing data or anything like that, always consider the source and what is their spin on it, what is their agenda, what are they trying to pitch when they're putting that information out there. So that said, there are still 2.7 million homeowners who are not caught up on mortgage payments, and 1.8 million loans that are seriously delinquent, which is 90 days or more past due and in foreclosure. The last couple of months, I've put up some slides that have talked about, back in 2008 and what those numbers looked like. And I don't remember exactly what it was, but there was essentially 3 years in a row where we had over 2 million homes that went to foreclosure. So this is a big number, but we had 3 years in a row with essentially slightly less than this number back in 2008. So this is a much smaller number than what we saw back then, even though it's a large number. And so the conclusion of this, and I'll jump down to the numbers here to show you, but the essential conclusion is that it's going to be, the impact would be very, very minimal. 77% of loans in forbearance have debt repayment plans. And we have a housing shortage, which I showed last month, of 5 million single family homes. That is a key factor right there. We have a huge housing shortage overall nationally. And so, while we don't like to see distressed sales and foreclosures, the fact is that even if all of these 2.7 million homes went to foreclosure, it's only half of the shortage that we have of needed housing units in the nation. So it actually wouldn't even really make a dent if all of them did. Now, again, and the other thing is they're not all going to go tomorrow. It's going to trickle over time. It takes time. Obviously, some of those are going to come. Some of those are going to come through to foreclosure. Some of them are just going to, be able to exit out of forbearance and be fine. This right here shows from the data that here's a breakdown of the percentage of what still exists and what stage they are in. And there's only about, where is it here? About 15% of homeowners exited the forbearance period without a workout plan, totaling about 400,000 homes. So now we're going from 2.7 million all the way down to 400,000, a very small amount in the scheme of things. That's only about 10%, not even 10% of what we actually need for housing supply. And it says right here that adds, so if a third of these homes end up in the market, that adds just 8 days of additional supply. If 2/3 go, it's only about 17 days of additional supply. So we're not talking a huge amount of supply added if all of these were to go to foreclosure. I should have done the math on this and just figured out how much more supply it would have been. So what's 10 times a third of a month? So what, 3 months of inventory ish that would be added to the market if all 2.7 million went on the market, which 3 months of supply is, we're at a point about 1 for the, it might be a little bit more than that nationally, 1.5, 2. So it puts us at 4 to 5 months of inventory, which is a pretty equilibrium market. So the worst case scenario is all of them go to foreclosure. We're in an equilibrium market, not a total buyer's market. not a ton of glut of inventory or anything like that. And then hopefully you're still there with me, because I'm going to go locally here. And again, this is the 5 million shortage of single family homes compared to 1.8 million seriously delinquent. And then it breaks the numbers down here by state. This is what I've been looking for the last few months, is one by state. So I'm excited to see this. So you see here, US, about 5 million shortage on single family homes, about 1.8 million 90 days past due. So if 2/3 of those were foreclosed and went on the market, that would represent about 1.2 million in additional housing units on the market, which still puts us about 3.7 million units short of our housing supply. Now you look at Oregon, because this is obviously a case by case, and this is by state, but it's obviously metro by metro even. But you look at some of these, and some of these states are not going to fare very, very well. You see Michigan here; they still have an oversupply, and they don't have a ton of foreclosures that are potential here. Only about 38,000 that are 90 days late. So, but it would add to their oversupply, right? And then you look at states like Texas, 1.3 million short. What's another 112,000 on the market? They're still way behind on their inventory. California, same thing. Florida, which is one of the markets that we're investing in, 700,000 units short. And if 2/3 went to foreclosure, they're still 600,000 behind. And then you look at Oregon here, we are about 100,000 units behind of needed housing units. We only have about 16,000 that mortgages that are 90 days past due. So we have a drop in the bucket for how many are due. Even if all of those went to foreclosure, we're still 80,000 units short. This is just not, it's almost a non-factor in our market and in these ones, above here. You start getting down into some of these other ones, where you're kind of even, or some of these other states right here where you've got an oversupply. That's where you start seeing some issues, and that's where real estate's always local. You definitely want to look at your state, your county, your city, your metro level, and see what the numbers look like there, because you cannot take a 5 million housing unit shortage nationally and say, oh, it's short everywhere, so we're good. You have to look at where you're invested. If you're invested in Michigan or Ohio, you've already got an oversupply. And again, this is state level. I don't know those markets as far as city and metro area level. There could be some metros that are just fine or hurting for inventory that you're going to be okay. But again, as a general statement, you're looking at the state overall. We're looking pretty good here in Oregon versus some of the other markets. So anyway, hopefully that helps. Hopefully that makes sense. Hopefully that alleviates any concerns that you may have if you're investing here locally, or if you're looking at some other markets. This would be a really good resource to look at to kind of see where they're at with inventory, what could be coming with the potential foreclosures. And I'm just kind of looking here now at the list. So you see like New York's behind, but they actually have they have more mortgages 90 days past due than they have a shortage of housing. So that's an interesting one right there. You start seeing where there's more past due than what they actually need. That's where you could start seeing some problems with inventory levels and with prices. So I'm going to just kind of leave it at that. Additional supply will slightly ease appreciation. Again, it's market by market. I don't know that the additional supply in the Portland area is going to be enough to do anything to alleviate that. And then this kind of just breaks down more what type of buyers are more likely to face foreclosure, and FHA borrowers are in the higher end as far as what type of loans. But yeah, I'd be happy to share this resource with you if you'd like to look at the whole article and all the numbers and look at your specific state and market and everything. If you're looking outside of Oregon, again, I just feel like this is not an issue with forbearance, any of that stuff, because we just don't have the supply levels that we are going to be a problem. And you saw the numbers I just showed you that even if all of them went to foreclosure, we're still way, way behind on housing units. So if I can be of any more help, if I can provide any more information for you, any resources, be of help in helping you reach your real estate goals, whether that's looking at another personal residence or transitioning from the one you're at, or investing and strategizing how to do that, I would love to do that. Feel free to reach out, message me on Facebook, send me an email, give me a call. I will put my information in the post so you can reach out to me. Would love to be of help in any way that I can. Thanks for watching, and let me know what I can do to be of help. Make it a great rest of the day.